And thank you for joining us. We felt this was a good time to have a call with all of you. So as always, if you have questions, feel free to type something into the chat window and we'll read it. Also, you can raise your hand. We can unmute you if you prefer to ask the question live. We can do that as well. And other than that, I'm just going to be quiet and let Dave take over.
All right. Thanks, Jen. Well, welcome everybody. It's obviously a rather testing time for sure. And it's not just the markets testing us, it's everything is testing us. I think it's pretty clear that we live in a time where we're more nervous about global events, obviously what's going on in the war. Could they use a tactical nuke? All those things that are talked about really day to day. And that, of course, lays over top of the market because we're dealing with real inflation. And the concern, of course, is that this administration is doing nothing about it, and they're not. That is a concern. And markets have a tendency of taking care of themselves, and I don't think this is any different. But normally we have some kind of policy changes or reacting to what's going on around us. And of course, in the investment world, that's what we have to do. We do that all the time. One of the things that's causing the market, in my opinion, so much distress these days is not just inflation. It's that is there going to be hope that the Federal Reserve can tamp this down? But can they, if we have no energy policy and energy prices continue to stay super high, which of course affects everything from deliveries of everything, of course. And we also, and I didn't even mention this, but we also have supply chain issues in China because they won't open up their economy, which is another very strange thing, but they won't. So we're in this place where it feels like leadership, whether it's overseas or here, has no message. I mean, it's not a message of any that would give us any hope. And that lays over top of the market, it lays over top of us. And I just wanted to kind of, if you will, start with this. We're going to run in a couple different ways, and maybe even a third way. That's just, I have to admit, that's sometimes how I run, is I may think of something and run a different way. But I really want to talk about how the market is really dividing things today. It's not all running together. And whether that gives us hope that some of it makes sense or not, we are trying to change some of the things that are out there because we have to. And I'm going to roll back just a little bit here and talk just briefly about one of the things that we've been doing for a number of years now. We've not owned bonds. You might have some municipal bonds at times that we've had, they're closed-end municipal bonds, but very, very few. And really more of a trading vehicle, okay? Not something we bought as part of a 60-40 portfolio. 60-40, believe it or not, we were actually reading articles like, here's a news flash, 60-40 is broken. You've heard me say it a zillion times in the last 10 years. It is broken. It's been broken. When interest rates are low, below inflation, or just simply won't work, putting 40% of your portfolio in bonds is a guarantee of a slight loss every year. That's not a plan, especially if you're trying to withdraw money, is that I just want to lose a little bit of money every year to inflation. How am I going to take money out on top of that? Now, we may be shifting, and we haven't done that yet, but we may be starting to shift more towards some fixed income as we go forward. And so I just wanted to not tell people, look for bonds in your portfolio, but I wanted to talk about how things have shifted. So the world is now saying 60-40 is broken. Okay, that's not a very good news flash, as I said. It's been broken for a really long time. But there are people coming to that. But interest rates now, even on a 2-year treasury, are up to 3%. That's how fast things have changed. And in my mind, that's what's really upsetting the market, much more than anything else, is that it's jumped, interest rates have jumped so much since the beginning of the year. The 10-year treasury was 1.5, it's over 3 now. Double since the beginning of the year. That's incredible. And it wasn't that long ago, we were well below 1%, 0.75, 0.6, not even at the low of 0.5. That wasn't that long ago. Things have changed very dramatically, and now we want to be able to position, if you will, moving forward. But I also wanted to relate that there's a number of things, as I said, that have worked. So we'll cover those, but I first want to start with some of the basics that we've been really talking about and really saying, look, the markets work. If we go with that assumption, and then I'll fill in some details later, I want to review again why markets work. And Jen, if you'll pull up that slide that shows, basically the dot plot, I think is what we call it. That'd be great. This is the investment returns for the S&P 500, right? Not bad. We'd like that. Anybody would like this investment, right? Who wouldn't? And yeah, there's a couple gaps in there, and we'll fill those in a moment. But we'd all like to have that. Again, as human beings, you probably have seen this chart before, but as human beings, we see things in a very linear way. We don't see things in a exponential and also, if you will, out of linear way. We don't see the back and forth with markets. And if we add the low prices of the year, this is what you get. So even in up years, for example, I think it's about 03. I'm just picking kind of in the middle of the chart. You see a down 14%, which is about normal for the year. That means it was down from its highs at least in this year, 14%. By the way, the long-term average, I believe, is 13%. 13. That's what the average drawdown is every year. Now, you would think when we draw down 13 or 14% that was catastrophic. Certainly media acts like it. And I'm not saying this isn't a bad sell-off. This is a very bad sell-off. There's no doubt. But we're down 14%. And at the end of the year, we finished up 26%. And you can pick any year. You can go back a couple of years, minus 12, up 20, right? And it's always worse also. We see down 10, it was down 17, down 13, down 30. These are normal. Doesn't feel normal, does it? Normally, you'll average a 13% drawdown, which we've already had this year. That certainly doesn't say it's going to stop. As you can see on the chart, we've had 30% drawdowns over the year. Stock market is volatile. It always is. It always has been. And in particular, it's more volatile today. There's no question. Volatility has ticked up a lot. We're seeing interest rates that have doubled since the beginning of the year. That's a problem. It's a huge problem for the market to digest that. It doesn't mean it continues to tank. It doesn't mean that corporations won't earn money. And that's where we have to keep our eyeballs are on the earn it. So are we going to have a recession? It doesn't look like it, but that doesn't mean we can't. Odds don't favor a recession at this time. It doesn't. We're still reopening. We have very low unemployment. Interest rates relatively are still very low. But if interest rates rise a lot and somehow the inflation really kicks in and the Federal Reserve overreaches, they could cause a recession. It often happens. But right now, there isn't one pending. Now, people will tell you there's one pending or there will. They've said that about 20 of the last 50 recessions. We don't have that very often. There are not that many recessions, but they call for them, call for them, call for them, call for them. That's what the doom and gloomers do. Now, as we look at this, though, I want to also say we have to be aware, with interest rates rising so much, what is working out there. And a lot of you, all we ever see really in a portfolio is, if you will, the statement, the bottom line. And April was so terrible, the bottom line is terrible. It is terrible. And it looks bad. But within that, this might hopefully help you understand what we're seeing and what we're pointing towards is within that, especially for those of you who are taking income or near to taking income, are pockets of money that haven't moved much. Now, if you look at your statements, and I don't mean you need to take them out now, but you'll see Franklin Income Fund is down like 2% for the year. I want to be exact. I've got my little notepad right here. Okay. So if you see me look off, that's what it's going to be. Income Fund of America off 4%. Now, here's what's interesting to me. Protection in bonds doesn't exist when interest rates rise. Bonds are down more than 10%. And I'm not just picking on the 30-year treasury, which is down worse. I'm saying bond funds are off 10%. So in that 60-40 portfolio, you've got the S&P off 13%, you've got bonds off 10. That's not protection at all. It doesn't happen all the time, but certainly when you're at or near zero interest rates like we were, I've said it a zillion times, if I've said it once, bonds can't work. That's not a prediction of where interest rates are going to go. They're too low where we start. It can't work, which is why we didn't own them. It wasn't anything that we're like predicting, wow, they really know the future. Nothing crazy like that. It won't work. We don't play. Simple. Cash is so far below inflation, it won't work. We don't play. Can't. Now, that doesn't mean you don't have some cash in your portfolios, and I've said this before on many of these Zoom meetings. We entered this year with the highest cash position we ever have. And the reason why is because markets were at all-time highs, and we had super high year-end cash distributions. Not a market timing call, just simply saying for people that need income, want income, we should not be quick to reinvest when markets are at all-time highs. That's why. And that's why the cash hasn't, for income people, really much been put back to work. We have several equity income funds, and this is where I'm going to shift in a moment. We have several equity income funds that are actually off only 3-4%. What are equity income funds? Dividend payers, the ones that are paying their dividends. And the market is liking that right now. So when we kind of hack the market in half, and I'll show you this in a moment, you're going to see that there's been a big difference in performance in different sectors. So what have we been doing besides bonds, though? Obviously, we have been putting money to work in some of these things are called interval funds. Many of you got these stupid things when one of them changed their name, for crying out loud, to Apollo. But those funds are actually up year to date. And I did not misstate that. In this terribly volatile environment, Blue Rock is up 10%, Griffin is up 4.5%. Those are huge positives to a portfolio in a very, very difficult time. And so again, understanding the different components of what's available for income, hopefully will help people understand and feel more comfortable, rest easier, if you will, that you're not going to run out of money. Not yet. Okay. It's not, this market isn't anywhere near a problem for us. We're always thinking out 2, 3, 5 years, depends on the times, of where money is coming from. And further, just to re-explain this too, for folks that are drawing income of why the market likes these dividend payers right now, is because it doesn't make any difference if Pfizer, as an example, Apple, Microsoft, companies that pay dividends, what their stock price does, the dividends keep coming in. And that's not a guarantee, they just always have. And what we're really looking for in portfolios are dividend increasers, not just ones that pay dividends. Because if you're not raising your dividend, then you're not growing, and we want to stay with higher quality. And that's really the lesson, if you will. Quality is winning. Quality always has, and that's one of the interesting things. It has always won out. It always does. But what we're seeing in tech world is it's just been crushed on the NASDAQ and the high-priced tech stocks, which have been the best things to own the last 10 years and still are far, far ahead. But we've seen a difference. And so we're going to put a chart up. It's really busy. I just want you to see it. And we'll kind of point out a couple of things. Don't worry. We get this in every week. And it just breaks out some of the different, if you will, categories within the market. And I just wanted to point out here, you'll see the third line down just above where Jennifer highlighted. The NASDAQ, which is very, very tech heavy, is down 22%. 22% as of Friday. Worse today. Another almost 4% as we're talking today. Just today. It's been crushed. And even as we break up the S&P 500, which is a way to go, you'll see the growth and the value, big difference here. So as we're seeing really boring old stocks like Dow Chemical, barely down. Actually, I think Dow's actually up, but I'm just using it as an example, where we're seeing Amazon off 30. We're seeing Netflix off 50, 60% from their highs. These stocks are off huge. Microsoft down. and all of the growth within the S&P. We've talked about this many times. We're seeing really mutual funds of growth that are down 50% in short order, 50 since the beginning of the year. Now that's crazy, crazy numbers. And you're seeing even on the value side, even when you get into the higher risk, small and mid-size, those companies are still not anywhere near down as much as we look at those. So again, we're not saying move everything to value, but we're now seeing a more, if you will, sensible market, a market that makes a little bit more sense to us, because those things that are getting punished the most are the highest risk, highest flyers. And you can see over to the right, you'll see exactly what I mean. They outperformed just in 2021 alone, and look at the 5-year averages for the NASDAQ. Even today, with a huge low, it has 18% compounded annualized growth. That's unbelievable. Where on the other hand, value is at 10%. Not even close to the compounded returns that growth is given. So again, we're seeing these differences in the market where not everything goes down, except for days like today. 2 days ago, this would have been Thursday when the market was just hideous. We were talking about how the market itself made no sense. Oil prices were up for the day and oil companies were down. In other words, it was just flush the toilet, everything's down, I want money, I want out, just go get money. Didn't make any sense. So days like this don't have to make sense, but what I'm saying is even year to day in the volatility we have like we have, it's making sense. And we have places to hide money. By the way, these interval funds I'm talking about, they are peeling off 5% returns. That helps us manage income in a world where we can't buy bonds, although we're getting closer to buying bonds. And that's what I want to say. You know, we're getting closer, and we're seeing where we're getting closer. That means some people are. And so bonds, I think, are at least short term, are probably not going to go a lot higher interest rate wise. Maybe confusing, but that also puts a little bit of a lid, hopefully, on this quick rise we've had with mortgage rates. And again, I hate to be a predictor of interest rates and things like that. It just means you get to be wrong a lot. But right now, it looks to me like the Federal Reserve will be controlling or pushing up the short end to try to catch up to what the market is telling us. Rates need to be at 3%. The Federal Reserve might as well get there tomorrow, but they won't. They'll take their time, 50, 50, 50, and so on, until we finally get there. But they're telling the Federal Reserve, you got to get to 3% plus on interest rates sooner than later. That's what the market's saying. Market doesn't have to be right. Things change and make us all look stupid. There's no question about that, including markets. So we don't want to say that the market is right or wrong or never going to be wrong, but that's what the market is pricing in. And that's why bonds probably aren't going to fall a lot unless we have another event, something that comes in that says inflation's even higher, hotter than it was, and people start worrying about, again, interest rates rising very, very dramatically. So with that, I wanted to say we are positioning in these, we're using instead some of these interval funds for bonds. We'll keep adding to those, but it is interesting as we look at value and dividend payers, how well that sector is holding up. What's killing all of us on our statements is anything tied to growth. Growth is not paying right now. It has been the big runner, but you're going to look for what we are going to be doing going forward is continuing to look for, if you will, if you want to call it a dead cat bounce, sometimes we do that. Well, what does a dead cat bounce mean? It means there's really no reason, except the market doesn't go down every day, that we get some bounces in the market, nothing fundamental, and we will be continuing to take those opportunities. We don't want to sell on the way down. You don't sell down on a day like this. You sell last week when the market was up for 3 days in a row on nothing, okay? That's when we try to make little changes, and they will be little. It's not an all or none, and I want to reiterate, that doesn't mean we're going to cash. It doesn't mean we're going to bonds. It doesn't mean we're going to go all value. It means over time, you start transitioning and moving money. That's how it's always worked. And it doesn't, you know, we've done this for 40 years. I don't know what the future is. Nobody does. And as we were talking this morning with my dad, it's just one of those things that, well, I guess we should have gone to all cash 3 weeks ago, right? Yeah, we would have, could have, should have, but here's the problem. When are you going to get back in? When do you get back in? It just doesn't work this way. And we got one final slide. We kind of created this one. Jen, was it like 25 years ago? We built this chart. I know, not super fancy, but it really indicates and shows how markets don't do normal. And I think it's just hard for people to kind of get that. We think the market does 10% a year, and that's what's in red. And it does do 10% a year on average, and it almost never comes anywhere near 10. It's always like up a ton, like it's up 27% like last year, and then it's down some. It's never in this 8 to 12% range we call average. It's never there. And it's just one of those things that throws our thinking off. Markets are down or up a tiny bit or up a lot. And that's kind of the way it works, and it throws people off. And I just wanted to reiterate, we don't know what's going to happen. Nobody does. And they all sound smart, and they all sound all-knowing because they know how to sound like, I was bullish when the market went up, I'm bearish when the market went down. They know how to sound that way. So do I, so do we. We just don't act that way because nobody is and nobody knows. The problem is, if you got out a month ago, when do you get back in? So I want to say this, we entered the year cautious. We continue to be very cautious. I don't think there is any reason the market goes down anymore or up from here, except for the 10 things you read in the paper every day. It's always doom and gloom, yes, but corporate profits are at a record high. Interest rates are coming up, so that affects, if you will, valuations greatly. But we are at all-time highs in dividends, cash flow, balance sheets, and earnings. I want to own the great corporations of the world. I just want to make sure in tumultuous times like we're in, that we're leaning towards quality, because quality will be in existence down the road when times get better. That's what we want to own. But it is no time to run for cover. It is time to continue to be cautious. Not time, just continuing down the same road. But it is hard. It's hard on us. And I'm just ready to admit it's hard on us as well, because we do bear that burden with you, for you, hopefully. Hopefully you've handed that over, as we talked about before. But we are attempting, if you will, to continue to dissect the market, find pockets of extra good value. And in this time, we are trying to bring down any volatility as best we can. And that's why you've been owning some of these interval funds, Franklin Income, value companies that you wished a year ago you didn't own because they weren't doing much, right? Now we're happy we have them. That's what a diversified portfolio is really all about, okay? Jen, have we covered really kind of the basics we wanted to today?
Yeah, I think there's one more slide. I'm going to throw it up and you can tell me if you wanted to go over this one as well. I thought you wanted to.
Oh, I sure did. Yeah, you're right. Thank you for that.
Yep.
This is very interesting slide to me, okay? And I think this comes, it comes from Goldman Sachs. And actually, that's why I forgot about it, because it came in this morning. I said, this is one of the slides I want to use. This just came in this morning to show all the years with the 13% plus pullback, okay? That is not in a recession, okay? Now, there's people out there arguing we're going to go into a recession, but we're not in a recession. Sorry, we're not in one. Now, we can go into one, and that would change this chart. But what is interesting is when we've been down 13% plus, which is where we are, that's why this chart exists, where do we end the year, and what is the average return for the calendar year when you've been down 13% at one point? And we are now. So the answer is 2. You can see the average on the screen, 2%. That means if we were to stop today, which we clearly are not stopping unless we stop in the middle of the day, we're not stopping, then the market would go up 15% plus whatever it is down today. And of course, there's nothing magic about 13%. The chart was stolen from the idea that the S&P is down 13% year to date. You can see it's been up as much as 27% after that, and as bad as down 23, which is another 10% from here. The key, I believe, is when we look at market setbacks along with the economy is that we stay out of a recession. That's where we're getting these numbers from. We have hit the maximum down, okay, except for 1 year when the market has been not in a growth phase, not been in a recession. So I found that very interesting today when this came in, that there is an awful lot of upside potential in this market for the rest of this year. I'll just say this. I'm not buying up 15% from here. I'm not buying up 20%. I'm not buying it's going down much more. I'm just simply saying we've been down a lot. This is a correction. Even before the war started, the market was in a corrective phase. It's not down that much since the war started. So it's not a circumstance where there's not any problem. It's all clear sailing. We've got lots of problems out there. The biggest, of course, is a lack of leadership in the world. It's a real void. I get it. It's a confidence gap. I totally get it. How can we fix our problems when they go around pretending they don't exist? How do we fix energy problems, energy crisis that we have when we won't even solve it here? It makes no sense. It doesn't. It's all political, but we'll figure out a way around it because we always do, even when it feels really bad. So we're not buying it. The market's going to go sky high. We're not going to get aggressive at this point in time. But what we are saying is that you really should be nibbling or staying whatever your portfolio allows for, and then continuing. If you're concerned, talk to us, let us know, and then into any of these rises, dead cat bounces, if you want to call them that, we can certainly shift a little. That doesn't mean cash. It's a further shift of a portfolio. Okay, and with that, you don't have to stand around either and earning zero in cash. That's something, if you are keeping a nice little secret from us, you need to let us know, really, because we do need to know, instead of just sending income and having you park in your savings account, earning zero, we really need to know so we can do other things with it. Okay. With that, Jen, let's open it up and see if we have some questions. Okay.
All right. You do. As we work through this downturn, should we stay the course with investing in growth stock funds that are outside of your accounts with you, i.e. 401ks? Should we be more conservative value funds? I am in it for the long term.
Again, long-term has to be defined. Do we have plenty of time? What I would do is take these opportunities where you're dollar cost averaging it. There's two ways to look at it. Okay, so I'm concerned about my 401k. So let's say I've been in it for a number of years and I've got 500,000 in my 401k. I'm still a participant though, okay? And I'm getting nearer to retirement. Absolutely nothing wrong with a rebalance on the 500. That doesn't mean bonds. It means making sure we've got some of those value funds that have been terrible performers for you. So you've been kind of moving away from those over the years. But I would absolutely take this downturn advantage of it by A, keeping some growth, and B, putting 100% of your contributions in. And Jen, if you can, while you're finding it, let's pull up a dollar cost average chart. If you can find one, that would be fun to come back to this question with, because really this is the best thing possible. It really doesn't feel like it if you're still contributing to your 401ks though. Okay. We'll come back and further answer that when Jen finds a little dollar cost averaging chart.
Let me give you this question real quick, Dave, and then I will go find the chart. Warren Buffett saying the market appears to be a casino. Comment on him stating that.
Yeah, for some people it is. There's no question, but I don't know what changed. That always has been. I've commented for, 30 plus years on the radio that this is not a casino. And for people that are pretending that they're not gambling, but day trading, and particularly with their phones through Robinhood and other things, that's just another outlet. I'm not saying there's anything wrong with gambling. I've always said there's nothing more fun than a great craps game, right? It's just fun. But that's a measured amount of money. We're not pretending to be investors. And so that's one of the things you always have to decide. Am I an investor or a speculator? And investors are in it for these kind of times, because suddenly, okay, I'm not telling you to go buy Amazon, but if you're a growth investor, you ought to be thinking about Amazon, Microsoft. These stocks are down 30%. 30. These are the highest quality growth companies. Nobody thinks they're going out of business. I mean, you might, but I've never heard of anybody. So when we think about those types of things, they need to be owned during times like this. Gamblers don't think that way. It's a cold table, I got to leave. it's cold. I want to buy GameStop. I want to buy Robinhood. I want to buy those types of things. And those stocks fly around. But the reality is they are not investments. Investments are, okay, I own Dow Chemical and they pay a 4.5% dividend. They seem to raise it pretty much all the time. Or I own Johnson & Johnson. I own Procter & Gamble, 3M. These are companies that have raised their dividends, by the way, a minimum of 50 years in a row. 08, 09, market tanks, income goes up. That's what those companies have done. And right now, those companies are starring out there because everybody's trying to hide and find things that have rising streams of income, and that would be dividend paying stocks. All right, here's the dollar cost averaging. This is showing 1 year, and I love this chart because it's over just a 1 year period, but it doesn't matter. It could be a 10-year period, right? Or 12-year, excuse me. But we're just saying over 1 year, you put in $100 a month. And you know, you have a green line, investor B, where it just kind of trickles down, and then finally at the end of the year, it comes back to where it was. And then the first one is you know, goes up a little, then it pulls back, goes back up, and pulls back down at the end of the year, still up 40% for the year. Now that's pretty high, and let's take a look at the values. Obviously, you got to ask yourself, who wouldn't want to be investor A? I want to be investor A because that is clearly much higher than investor B, 40% higher to be exact. But what happens is when you're buying these shares at today's or whatever price it is, right? And so investor A, because the fund, the investment did better, only wound up with 86 shares at the end of the year. Investor B had 203 because they tolerated the downturn. And you'll see at the end, of course, that gives a value is very substantially higher for investor B. And you can play with the numbers a little bit, but it really, I think this shows people the idea of buying these dips. So please, when you're adding 401k, adding to investments for your kids, your 529s, all those things for the grandkids, keep adding. Don't pull back. That would be the dead opposite. Nobody sets out in investing and says, I hope, or anything, I want to build a dam, so I have to buy enough gravel to build the dam. And I'm going to do it over the next 20 years because I can't afford all the gravel today. Nobody says, I hope that gravel goes up every single year because I want to pay more and more and more every year for my gravel. He said, well, no, it is exactly like gravel, because what we end up with is we're just simply saying my portfolio, which I'm doing nothing with while I'm accumulating, nothing. I'm doing nothing with it, is I want to look at a bigger and bigger number, just like I would at my pile of gravel. I don't want to. I want to see the prices go down so I can accumulate more at lower prices until the day when I turn it into income, because Pfizer, Johnson & Johnson, all the others pay their dividends based on how many shares you own, not their price.
Okay, a couple more questions. First, an additional comment on Warren Buffett was, do you think he's trying to comment the market back towards long-term investing?
I would think that's the point he's making. In fact, I know it is. I know that's the point he's making, is that markets work when they're treated as investments. Markets don't. And all of those people that are gambling in it have to be taken out. All of their money needs to be taken away. And then the market will return to normal. It's not that the market cares one way or another. It's just that the people or the people in the market returns to normal. We have speculators. People had to learn. Every generation does. And they all speculate at different times. Everybody wanted to buy a house in 2005 and 6. So everybody didn't just buy a house, they bought 10 of them, levered it up, and went bankrupt. And that just kind of occurred on a, well, if you will, all around the country. It happened. People levered themselves up. People did it with oil companies, oil and energy, and different plays within oil and energy, and real estate in the 1970s, because with inflation, it's never going to get any better. It's always going to be that. And of course, all of those went under as well. So whatever everybody knows isn't worth knowing because it's priced in. And that's one of the reasons that Warren Buffett and others have done so well over time, because they do have patience. to wait out times where companies that make no money, like the dot-com era, late 1990s, we had to have a whole generation move from day trading, trade at home. You don't have to think about it. Dividends are stupid. Books were written that way. Dividends are stupid. And buying companies that don't have any earnings. They had to go and destroy that capital. And then we grow from there. These things happen. That's what's been happening. I'm not going to feel sorry for the Robinhood traders. I feel bad for anybody that has to go learn that lesson. But it seems like we do. And they did learn that lesson, or are in the process of losing every single nickel of what they borrowed or set aside in their GameStop and all those other Reddit companies. So that's what they're referring to.
Okay. Is the government selling 3 to 6 month T-bills again?
Oh yeah, yes they are. Absolutely, they have been. I will just simply say that probably the sweet spot in the market out there now, from my perspective, is around the 2-year. If you can buy bonds of any duration, we do it all the time. We haven't in a long time, right? But going back a few years ago, when you could get something on it, then we would have alternatives to say, hey, I want to pull my money out in a couple of years. Let's go with that. But we have really been shifting more now towards these interval funds for money people don't necessarily need or have at least a 1-year wait on, because they are paying over 5%. And they really have no correlation to the market. As I said, they're actually up year to date, which to me is crazy and to think about, because you've got growth. I was just looking at Growth Fund of America this morning. Goodness gracious, it's down nearly 23%. Well, and as I speak, it's way down way more than that, because the market's getting clocked again today. So it's down 23% through Friday. That's crazy bad, but totally on track with what's going on with the NASDAQ right now, and growth stocks getting killed. So you think about down 23 in a mutual fund, and then another mutual fund up 10. This is not intelligence. Growth Fund of America over the last 10 years has killed this fund, okay? But that's the times you put in between. And so that's why when we have a non-correlated something that's done well, that's why we're using it so much.
Okay. What about 529 plans? I have all the grandkids in aggressive growth. The oldest is 14. Time to change?
As you get to 14, aggressive growth should probably move down to growth. Okay. But if you want to wait to get a bounce in the market, I would think that would be a better idea. But when you do, you need to move, not feel confident. You need to move and begin to take it down, because you don't need it all there by any stretch, right? Because when you hit 18, we're talking about, let's just call it 4 years of an education, or at least 2, right? For a trade or something like that. So we're not talking about needing all the money out the first year. So we're really dealing with 4 to 8 years, something like that. And so putting money in now, and if you're still contributing, that's great. But as you get closer to needing it, you want to kind of cut those back. And so we really think that as you get into your 14, 15 years old, you really need to be cutting back. It doesn't mean you have to do it tomorrow, but we do need to be starting to cut it back. Growth and income, not to cash, not to guarantees. And it feels that way as you get closer, but we've got 4 years to go.
Anyone else? Don't see any more, Dave.
All right. Well, hopefully this thing is going to quiet down. Hopefully we're going to find some leadership in this crazy world. And in the meantime, one of the things I really want to again point out and say is we're here. Call us if you need us. And as we laugh sometimes, it's not, we're thinking about this all the time, but we don't know the future. And so, yes, we are trying to position portfolios that are going to do okay, but when times are like this, we're all going to lose. The thing is to be thinking about, if you're needing income, if you're particularly concerned, 1, pick up the phone and call us. 2, you really need to be understanding that there are different pockets of money that are okay for times like this. We don't have to sell down. That's the death of a portfolio. And all the losses in the market for all of our lives are temporary unless you sell. That really is true, as trite as it sounds. Have a great weekend, and everybody, and thank you again for being our clients. And if you need anything, we're here for you.